One of the first things I like to do when I'm talking to someone about loan servicing or managing loans is I like to talk about money flow. And I like to use these diagrams. I have a few here that I'm going to show you. We're going to start with this simple one. And this is basically what loan servicing means when you're servicing loans. Specifically, you're servicing loans on behalf of multiple owners or multiple investors. So we're going to go ahead and put our loans into a system. Each loan is going to have both a borrower and lender side. We're then going to send out a bill, or the borrower has a coupon book that we've already sent out, or we're going to ACH them. Money's going to come in from the borrowers, go into a servicing trust account, a clearing account. Its basic purpose is to bring money in from the borrowers, have it go into that account, have it sit there for 7 or 8 days while you wait for the checks not to bounce, and then we want to send the money out to the lenders and vendors. Next month, you're going to put some more loans in. You're going to send out bills, coupon book, ACH. Money's going to come in, money's going to go out. January, February, March, April, May, and so on. There's obviously more detail to it. It's a bit more complicated than this. And in this slide, I like to talk about tricks of the trade, different procedures, ways to streamline and automate your routines. Here we have a scenario or a diagram for, so we're still servicing loans. This area right here is what we were looking at previously. But now we have a couple of funds, and the funds are lenders. That's what a fund is. A fund is a lender. We're gonna do this up here. We're gonna put our loans in. We're gonna send out bills, coupon book, ACH. The money's gonna come in. It's most likely going to come in and go into this bank account first. Doesn't have to. It's a good idea to have all your money come in and go into this bank account first. Sit there for 7 or 8 days. Wait for all the checks to clear, and then we're going to send money out directly out to any of our direct assigned investors. What I would refer to as a trusted investor or a direct assigned investor. But what about the loans that are owned by the funds that we're administrating? Those funds are going to come down here and get put into this bank account and this bank account. Maybe we're setting aside taxes and insurance money so we can pay their taxes and insurance throughout the year. Right? So principal, interest, taxes, insurance comes in from the borrowers, gets deposited into this bank account, sits there for 7, 8 days. Principal and interest goes out to trusted investors or direct assigned lenders. Money goes out to these fund bank accounts, principal and interest. Goes out to these fund bank accounts where it builds up and up and up until the end of the month or the end of the quarter. These funds could own dozens or hundreds or thousands of loans. And that money is going to come in and build up and up and up for an entire month or an entire quarter. And then we're going to distribute money out to the fund members. Remember, principal, interest, tax, insurance is going to come in and go into this bank account. Principal and interest is going to go out to whoever it's supposed to go out to. Tax and insurance money, impound money, is going to go into the impound account or the escrow account and build up and up and up. And then we're going to pay the borrower's bills on their behalf. We're going to perform annual escrow analysis, and we're going to do some other things, some reporting things. So here's a bit more sophisticated or a bit more complicated operation. Then we can get into scenarios where make this a little bigger here. So we're still servicing loans. We have a receiving account, a clearing account. All the monies we send out bills, coupon book, ACH. To all our borrowers, all the money comes in, goes into this account first. We deal with all our bounce checks and all our chaos in one bank account. Wait for funds to clear. Now we have funds going out to 4 fund accounts. I don't have escrow set up. I'm not doing taxes and insurance in this diagram, but I do have a construction and a prepaid interest account. So these are what we refer to as settlement accounts. So these accounts are, say for example, I made a construction loan to someone, and part of the agreement is that I'm going to make them a loan for $1 million. I'm going to go ahead and take their $1 million, make the loan to them, put their $1 million in a construction draw account, and then I'm going to dole the money out to them as they're, completing their various phases of their project. Here's another example, and that's an example of me setting up an escrow draw account, an escrow construction draw account, which a lot of folks that we work with do all the time. And those funds are supposed to be held in a separate bank account, right, by law. All the systems we work with are sophisticated enough to there's a lot of flexibility in these areas. But these are supposed to be separate bank accounts. This is supposed to be a servicing trust account. Its only purpose in life is to receive money in from borrowers. Sit on it for a few days, wait for the checks to clear, and then money goes out to everybody. Fund, if you're administrating funds and they're a Reg D 506, you are required by law to keep each one of those funds, monies in a separate bank account. Here's a construction draw account where in the example I was just discussing, I made a construction loan to someone for $1 million. I put their $1 million in this bank account where I'm maintaining subsidiary ledgers for that construction project and all my other construction projects. And I want to be able to keep track of all the monies in and out of that subsidiary ledger in this bank account. And then here's another example of a settlement account. These actually could be the same bank account. If it was me, I'd want them to be separate bank accounts. But here's an example of I make a loan to someone. Let's say I loan them $100,000. At closing, at funding, I send them $70,000. I hold back $30,000 and I put it in a prepaid interest account. And then I just pay myself out of their bucket every month instead of having to send them a bill. So I would refer to these as settlement accounts. I'd refer to this as a servicing trust account. These are fund bank accounts. And in my opinion, they should all be separate bank accounts. It's just kind of best practice, regardless of whether or not, you might have some form of a fund, but it's all real tight-knit, friends and family. You're not under the rules and regs of a Reg D 506. You're not in a particular state where they require your funds to flow in and out of separate bank accounts. You're loaning all your own money. You're not subject to anybody's rules and regs. So anyway, here's yet another example. So look at this one. We're doing it all here. We have our servicing account, sending out bills, coupon book, ACH. Money comes in from borrowers, goes into this account, sits here for a few days, and then out to all the lenders and vendors and funds and so forth. We have an escrow account, a RESPA regulated escrow trust account, where tax insurance money goes into, builds up and up and up, and then we pay tax and insurance bills. And we perform our annual analysis and refund back anything over 2 months cushion. We have our construction draw account. We have our prepaid interest account. So that's about as sophisticated as it gets. So again, I hope that was helpful. These don't have to be separate bank accounts. They should be separate ledgers at the very minimum within whatever system you're using. So anyway, there you go. Thank you so much